All right. Good morning. Good morning, everybody. TGIF. We made it into the short week. We got the whole nation with a focus on this storm. Everybody be really careful this weekend. It's going to go into the new week. So by Monday, there should be, some pretty nasty weather just about everywhere. So get prepared, get comfortable, settle in, try to stay home, avoid getting hurt. I was looking at my position on Intel yesterday, and since they were reporting, I was looking to change or manage or do something with it. I was going to sell some calls against the shares that I own, and yet I couldn't I couldn't find a good value because a short call won't protect you from the stock just tumbling into the dirt, right? It's not designed for that. It will just help you out if the stock is a bit laggy. So I went ahead and closed it out. I think that was a good call. There's always another opportunity if I'm wrong and it turns around and goes back up. But it was down 12% this morning. So all told, I'd say that was probably a pretty good decision. There's still a lot of shenanigans going on, a lot of eyes on Japan. Um, it it is backing off a little bit now, but it started to surge earlier, and there was more talk about intervention. Even with this little bit of a pullback after that initial surge, the threat of intervention is still there. So kind of keep your eye on headlines on Japan. We got two major data groups this morning. 10:45, which I believe that's 9:45. Yeah, 9:45 composite PMI flash. That's going to be one set of data points. The other one will be at 10 o'clock. So the whole morning is pretty much just wrecked. We'll let that go. And perhaps look for some opportunities in the second half of the day. Just, be mindful when you're running 0 days and it's a Friday in the afternoon. Price has a history of making exaggerated moves. So you want to be careful with those short plays. Other than that, it looks like we're just going to work on making it through the weekend and surviving this crazy storm. Yeah, we're seeing just very minor shifts in what is being priced in for rate cuts. Nothing significant. These little 1% and 2% changes, don't even let those bother you, right? That's nothing. If it was something major, we would see it. It'd be a significant change. It would start unwinding really quickly. So we don't need to worry about that. Last thing we need to check on the news side is what's coming out of the White House today. And it looks like we are set up for low risk today on that end. All right, so we're looking pretty good for the day. We just have to get through this morning session, right? It's kind of the big one. Yeah, hot chocolate does sound good, doesn't it? Make hot chocolate and then sprinkle in frozen coffee. It's the only reason I ever keep frozen coffee around is to put it in hot chocolate. Yeah, sounds pretty good. The call wall and put wall stayed in the same spot, so no change there. We are back above the zero gamma line. We're above the put wall, but we're still underneath the volatility trigger. So gotta kind of keep our eye on that 58 area. We are inside day. We tested yesterday's RTH low and it held. That's just a quarter level, 69.25. The base case argument today, unless we get some wild shenanigans that really shakes the market out of its foundation, this should be our day. We should stay within yesterday's range, just kind of digest around the 10 and the 20, and go into the close with a little bit of whimper, right? Just nice and easy. If things were to break loose, say headlines turn us bullish or headlines turn us bearish, then the range is already set in the broader space and we've got easily recognizable targets. So can't argue against how nice of a setup that is. It doesn't matter which way we go, right? We've got destinations. So this is what we are in a gift. It doesn't get much better than that. On that upside push, be mindful of the gap close. That's likely to cause a little bit of a speed bump. And then, of course, all of this is indications of warnings of previous attempts to get and hold above 7,000. And to the downside on the break, you got the round number, which also lines up with the 50-period daily moving average. And you have the half back of all of this, right? So those would be two levels of concern. That halfback should line up really good with this. I'm not saying it's going to be perfect, but that's kind of the idea, right? So you're defined really well here. Um, I I see this as just such a great opportunity. If we break out, and that's kind of the little caveat that I don't think we're going to break out. I think it would require a significant headline, and I don't see where that's going to come from this morning. Don't get me wrong, surprise headlines, which we can't see coming anyways, are always a viable threat, but that's like predicting lightning strikes, and that's just not worth it. So if we break down, you've got a very clear roadmap, or if we get out of this box, you've got a really good roadmap. But my base case for today is we're going to go quietly into the close. And I wouldn't be surprised. Well, I wouldn't be surprised if we start to lose participation and volume this afternoon as everybody maybe tries to cut out early and start dealing with the preparations for this storm. I did that late yesterday afternoon, and it was already a madhouse trying to get into the grocery stores, and that was frustrating. Reminded of how much I don't like people, which is funny since, I'm working on my doctorate in psychology. Continuing to build out the YouTube channel, so please go over there and help me grow that channel out. The charts that I use in this morning briefing are shared in the description of the YouTube channel so that every video has the description and it has these charts for Thinkorswim and for TradingView. Like, subscribe, share it with others, comment on the videos. You know what I mean? Do everything that makes the algorithm happy and boost the channel. I really appreciate it. Over the years, I've had people that wanted to monetize this morning briefing, lock it behind a paywall, make people subscribe to it, and I've never really had much interest in that. Right? I don't want to charge people for it. I want to just help somebody out. So let's just continue to do that, right? Help others, share it. The YouTube link is in the same spot as the link that you used to show up in the stream, right? It's in the same post. Every morning I share the post and it has the link to join the Zoom and it has the link to catch the replay. We have a market maker move this morning. They are hedging. What are they hedging against? Now, don't get me wrong, they're always hedged, right? It's not like they just decided, oh my goodness, we should go get a hedge. You know what would be really fun? It'd be fun if we went and got some hedges. They were already hedged. They are always hedged. But this is additional hedging. This is like having homeowners insurance and then hearing about this massive tornado coming at you. And you call the insurance company and say, I want to get some tornado insurance. Short term, 1 month. No reasons really in particular. Just decided I want an extra month. So they're getting extra insurance this morning. Why? It could be because of the flash services PMI. It could be. I'm not necessarily believing that, especially since it's a little early for them to be hedging. You know, it's 4 hours away. You'd think they'd wait a little longer. They typically would. It's possible that it's because of Japan that they're starting to hedge early. All right, so either way, sometimes we can find the why and sometimes we can't. I don't want to get hung up on trying to find it. The way the system is designed is even if you can't find the why, just recognizing that they are hedging is the warning that you need, right? So we know for a fact that they're worried and that they are spending additional money to protect their positions. Remember, for them, a hedge is not a trade. For you and me, we can hedge and make it a trade. We can define our risk with it, even get free hedges when we work at it. But for them, a hedge is nothing more than loss. It's lighting a fire and just throwing money in there. They don't get their money back. So when they spend money on a hedge, they're worried. They're going out of their way to protect their position because they have identified some sort of risk that makes them believe that it's worth the money to spend on the hedge. Now, this isn't my opinion. I'm not assuming that they're hedging in any way. I'm telling you for a fact that they're loading up with additional hedging right now. We can see that right here. If you don't have Thinkorswim or if you don't have that label on Thinkorswim, you can go into the trade tab. The market maker move is right here. If the product you're looking at has a market maker move, I've reached out to them about this. I've asked them to change it. If it doesn't have a market maker move, they should at least leave the 3 M's and just put zeros here. Because I've had people reach out and say, how'd you turn that thing on? I looked at, I don't know, what, Tesla, and it wasn't there, and I was trying to turn it on, and I don't know how to turn it on. Well, you can't turn it on. If there is a market maker move present, then you'll see that. And if there isn't a market maker move present, then it just won't be there at all. If you're on another platform other than Thinkorswim and you want to see it, then you want to look at the options chain. Look at the front expiration versus the next expiration out. If the front expiration is a bigger number than the next expiration out, then you're in the situation of a market maker move. It's as simple as that. Now there's some logic on the why behind it. How does it work? What is going on that causes that to happen? And at some point we could probably dig into it. There's some really good articles on the Schwab website that go into this. When TD Ameritrade owned Thinkorswim, they had over 25 plus articles about this thing. Schwab bought it, condensed all those into like 2. So, we lost a lot of great background and depth and context, but they do explain what it is, how it functions. The main thing to take away is those articles won't talk about the futures. They'll only talk about equities and basically earnings or binary events like earnings. But if they are trading out of the money options, that trade activity messes with the implied volatility average within each option group, because you can see that each option has its own implied volatility if we were to turn that on. So they come in the morning, they start trading out of the money options, it jacks up the implied volatility on that one particular options strike. And it only calculates on the out of the money options, right? So it's those out of the money calls and puts that they're trading in front of an event. The implied volatility average is a proprietary formula. They don't tell us all the ingredients, but we know that it has the out of the money options, the implied volatility of the out of the money options, the bid and the ask, the pace of the tape, how fast they're building positions, how aggressively they're building them. Are they hitting at the ask and above, at the bid and below? There's also a bit of a factor on the square root of time, and it's just this whole entire thing, and that's what sets this implied volatility here. So when that number gets higher than the next one out, it triggers this idea of a market maker move. If you're on another platform, as long as you have the options data here, then you can see it. You can see if there is a market maker move, and there is right now. We want to keep our eye on this number through the day and watch for it to start to decline. It will not live longer than today because it's using options that will not be here tomorrow, right? So at some point today, even if they didn't unwind this position, the numbers would start to drop because we would be nearing the end of the day. And at the end of the day, it's going to go to 0. But they'll unwind it before that. Once the event has passed, they'll unwind it and it'll be gone. It'll just disappear. So keep your eye on it. It's 0.28 right now. It may continue to climb as we get closer to whatever event this is that they're worried about. And then once we're past that event, it will begin to decline and then it'll just disappear. That is the market maker move. If you wanted to search for it on Google, you could just type in Schwab or TD Ameritrade, Thinkorswim, and then use the MMM. You'll find articles on it. We got near the upper edge of the ADR this morning, but we didn't hit it. It's another argument for my logic that I think today's just going to be a sideways day and that we go into the weekend within this zone. Unless we happen to get some shock and awe headline that moves us out of the box, I am very comfortable on the idea that this is going to be our trading day. We didn't even get to the high of yesterday. We didn't get to the upper ADR half. It's possible that we could break the RTH low of yesterday, and if we did, we'd still need to challenge the full low of yesterday, and even then we wouldn't be to the ADR half. So, you know, I'm pretty convicted on this statement that I think it's going to be a sideways day. Now, if you trade options, then you're probably pretty happy to hear it's going to be a sideways day. I like the sideways days when it comes to options. Just be careful, right? Sideways days means we haven't run yet, and at any time, one spark could send us moving, and that would really ruin your afternoon, right? Today's floor pivot is higher than yesterday. That's bullish. Price opened underneath it. That's bearish. They don't cancel each other out simply because of how far the pivot point is. I don't have any, solid data on that, but it's a significant change in structure, and so I would still count that as bullish even if we did open up underneath it. It's a narrow channel, and narrow channels imply that if we break out, we keep it. What that statement is talking about is yesterday's price action. And what it's suggesting is if price breaks out of this range, that it just keeps right on going. It doesn't come back inside the box, which suggests we wouldn't want to use 111 or 1236 on a day like this because it's likely to break that and just keep right on going. Just keep in mind that these channels don't make price do anything. It wouldn't stop us from breaking out, and it won't help us stay broke out even if we do get a breakout. It's just providing insight or perspective. I've seen markets break out with really big wide channels, and I've seen them stay inside all day with super skinny little narrow channels. So it happens, right? Yesterday was a MDP, that's a missed daily pivot. Today, obviously, is not. We've crossed through it multiple times, and right now we're struggling just to get back above it. We have not yet interacted with the S&R lines, although they probably are not very far away considering the range of yesterday. All right, so R1 and S1, we got close to R1 but didn't hit it. We've gotten nowhere near S1. Again, that kind of solidifies my argument that today is likely to be a sideways day. Again, from an option standpoint, a sideways day, pretty good. From a future standpoint, a sideways day, it is possible to get some decent trades. There was yesterday, right? So we could get some decent trades today, but it's less likely than yesterday. That's because yesterday we were building the sideways day. Today we're talking about staying inside yesterday's sideways day, right? That's why it's less likely that today will have good clean price. But, stay positive. What we don't want, at least what I don't want, is to trade things that look like this. So if the day looks like that all day, I have absolutely zero interest in participating in that in the futures. I'll still do it with the options though. I'll take that and smile all the way to the bank. So we have our levels, and we have the bias, and we have the threat. So keep your eye on the threat. Eliminate that market maker move as any sort of an issue. And just be mindful that if we test the edges, we're more likely to come back in. Overhead, we have the weekly floor pivot. So if we do get a breakout of yesterday's high, That is the target and the significant resistance for at least a first touch play. First touch plays offer a good, 4 to 7 points. Usually take those with 18 to 25 contracts. It's decent. It's decent. If we did get above that, then target R2. Right? That would line us up also with this point of control from last week. So another reason to believe that that first touch play may offer more than 4 to 7 points. I'll take that. We are working on the second distribution of the week. If we don't go anywhere, it's likely we're just going to build this zone out, holding above the value area high here, and we'll call it quits into the weekend. If we begin to break down, we have this week's point of control at 68.66. It's a little bit lower than this point of control that we were using, which is basically like 68.80. So maybe consider 80 a bit of a speed bump and 66 as a destination. Ten-day, 30-minute volume profile and TPO. Their point of controls are lining up a little bit better, but we're still looking at a pretty ugly distribution here. There's nothing to the downside outside of this value area to offer any clues or insight into new levels. We're going to take some of these candles off today, and then a big chunk of them will be removed Monday and Tuesday of next week. And at that point, we'll be more concerned with where the heck are we going to see this new point of control at? I'm fairly convicted it's going to be at 69.50, but I'd say let's get into Monday and then we'll see where that is. It would be a lot better if we were above it when it ended up at 69.50, right? I would not like to be underneath that and then have it moved down and stacked on top of us. So we'll have to see what that looks like next week. But you can see the TPO, really, I guess it's more at the 60 level, but the TPO really fleshed that out. And who knows, we may lose these candles right at that level, and then we lose that. We'll just have to see it play. The main thing is it's going to move, and it won't be over our head for very much longer. Likely by Wednesday of next week, we will see the point of control in a new home. We do not have a new VPOC from yesterday. We've cut through that level multiple times already. We're done with that. We got two overhead and one underneath us. They could interfere a little bit if we were to get headline news that broke us. Just keep in mind that it would be shock and awe headline news that did break us, and these levels were never designed to withstand that sort of activity, right? So we would push right through these. I would not run first touch plays on these on a day like this. Not these. This morning's distribution is telling. We'll see if it starts to fill in a little bit through the morning, but yeah, that's a bit odd. All right, as we do usually on Friday, we get a glimpse of what next week's range looks like. Just keep in mind that this is only a projection. It's not yet locked in place. It's still alive. It's still moving. So until the end of the day today, it will move with price. That gray line is where we are right now. So as we move up and move down, the gray line is going to move with us. And of course, the red and green line are going to continue to expand and contract around that gray line through the day. After the close today, after 4, usually around 4:30 or even closer to 5 o'clock, all of that will just lock into place, and then that's it. It won't move anymore. Just like all of these in the past, they are now stationary. They don't move. So that when we come in on Monday, we will have the new range. One of the things that I like to do with this range on Friday, even though it's still moving around, is compare it to the week that we are currently in and see how does it compare? Because this is a perception of volatility. When the range is narrow or wide, it gives us an idea of what the options market participants are putting their money on. I like this so much better than some bobbing head on TV telling me what they're doing with their accounts, right? Because they can chip their teeth and say whatever they want. And usually they're lying out of the side of their neck. Follow the money. If they think that next week is going to be violent and volatile, they'll price that into the options and we'll see it with the width of this box. If they think that next week is going to be a hurry up and wait week, they'll price that into the options and we'll see it with the width of this box. But there's two ingredients to this box. One is the options and where they're trading those options. The other part of it is how many days are in the week. This is a 4-day week. Next week is a 5-day week. You can see the range that I've drawn here. It's the projection for next week's movement. They have anticipation that next week will have as much movement as the week that we just spent. But next week's a 5-day week, and we were in a 4-day week. If you can travel 60 miles in an hour, how fast were you going to travel 60 miles in 30 minutes? That'd be the idea behind this, right? That they're getting the same movement next week with a 5-day week that we're getting with a 4-day week. Next week looks to be a little bit of a hurry up and wait week. And that would make sense because next week is FOMC, the 28th. So they're pricing in a hurry up and wait for Monday and Tuesday. We can see that by the width of the box. That might make for some decent tradable opportunities if you were to build some short duration iron condors for, say, Monday or Tuesday of next week, and or build out some butterflies, right? The idea being that we can close on the edge of this weekly expected move on a Monday or a Tuesday of next week. Those should be relatively cheap if you were to do that with, the SPX options, but really SPY, SPX, XSP, whatever you want. If we're going to go into hurry up and wait mode for Monday and Tuesday and half of Wednesday, then in previous FOMCs, a lot of times we do just go sideways and we don't do anything. But there's a number of FOMC weeks where on the Monday of the FOMC week, we explode and we run all the way to the edge of the expected move, like this FOMC week right here. We gapped up and got near that edge on a Monday, and on Tuesday of that FOMC week, we closed on the edge of the weekly expected move. If you had set a butterfly there, then you risked, say, 5 pennies. That's $5 in the options language. You could net $400 on a $5 risk. I like it. So something to think about. It's probably too short of a time frame for like a double diagonal on just a Monday or a Tuesday. It's just not enough time. But you could do an iron condor. I don't like that one because, well, we haven't run those since COVID. The ranges are just too big. But the butterfly on the edges, yeah, not a bad idea. Since we haven't gone anywhere, our distance from the 10-day is fine. We're just slightly under. Probably can't even see that unless I zoom in here really well. So that is our distance from the 10-day right there. And we're just barely under the 10-day. Now I've got a bit of an imaginary color when it comes to the 10-day. A half of a percent above and a half of a percent below. And we are within that little half of a percent boundary. So we're like in the center of the basketball court. We could make a 2% move up or down, and we wouldn't even be considered overbought, overextended, or anything like that. Looking at things on the weekly, we are above the 10 week, but less than 1%. So that means we're close enough to it that we can just go right back to it again. It has a bit of a magnet or a gravity around it. Now that we're at that level, it may require a headline to get us away from it. Otherwise, we might need a sharp pullback to get some momentum going and then get an upside move to break through it. It's one of the lessons we learned with the Laguerre, right? Otherwise, we look good, healthy. We haven't moved too far, too fast. It doesn't owe us any sort of a pullback, and we have no expectations for any sort of mean reversion because we haven't gone anywhere. We haven't done anything. Looking at what's down this morning, really, we don't have anything down enough to meet our qualifications. The chips are down, just not enough. Same with banks. Banks are down, not enough. So keep your eye on SMH and XLF or swap XLF out with the banks like KRE or something like that. Keep your eye on them. See if they do get down more than a half of a percent and continue to get weaker through the morning. Looking at what's up this morning, uranium, solar, gold miners, precious metals, energy, more energy, generic energy. These are not the sectors that you want to see if you're looking for a rally day. But we already knew that, right? We knew there's no expectation of a rally day today unless it's triggered by a headline. That's my base case. We're just not going to get one unless we are forced. And we can be forced, right? It could be one of those forced buy, grind high kind of days. But we don't see it. Not this morning. Silver, solar, crude, uranium, pot stocks. That is not what you're looking for a rally day. All right. So, as usual, we want the Mag 7, chips, tech, consumer discretionary, cloud, computing, that sort of stuff. If we don't get that, then we need significant dealer positioning in the 0-day flows and the indexes. And we won't see that this early in the morning, right? So no rally at this point, no rally day anticipated. I'm looking for a sideways day where we hold the range, stay inside the lines, and go quietly into the close. The two orange lines are basically our range for today, unless we get some sort of macro headline that breaks this out. Simple enough. While you're at it, you could look for reciprocation. This would be a little tricky because of how much we were outrunning that VWAP earlier this morning. You could do it this way. I'm not a big fan of that right now. Since we've already closed the gap, it probably would have been better just to measure that, right? So do both. That would be your escape velocity target. This one makes more sense. This is reciprocation, right? It gives us what it owes on the other side. This measurement is yesterday's 111. So it is valid. Can't make that stuff up even if you wanted to, right? The measured move target is yesterday's 111. So if we do get a breakout, I'm going to short that sucker and run it back in again. That's the plan. Everybody, be careful, be safe, have a good weekend. I'll see y'all next week.